What if every financial disaster from the Great Depression to the 2008 meltdown wasn't just a random accident? What if I told you they were all connected by the same hidden pattern, a predictable sequence of events that plays out with chilling regularity time and time again? This isn't chaos, it's a script, an orderly, seven-stage process driven by the timeless forces of debt, speculation, and human nature. In this video, we're going to reveal that script, a seven-stage framework that the world's most successful investors use to understand the massive cycles of boom and bust. We'll show you exactly how this pattern appeared before the Great Depression, the 1989 Japanese collapse, and the 2008 global financial crisis. And most importantly, we'll apply that same framework to our economy today, in late 2025, and show you why the evidence suggests we are standing on the edge of the next great downturn. The recent moves by those who understand this pattern signal that the next crash is no longer a question of if, but when. Before we look back, you need to understand the pattern itself. It's not some complex formula on a chalkboard, it's a sequence, a seven-stage feedback loop that once it gets going is almost impossible to stop. Think of it less like a single number and more like a combination to a lock. When all seven numbers line up in order, the vault of the financial system tends to break open. This framework isn't our invention. It's a synthesis of decades of work by economists and investors who've studied these cycles. People like Ray Dalio, the founder of the world's largest hedge fund, have built their careers on identifying these long-term debt cycles. They understand that history doesn't just rhyme. It often repeats with an almost mathematical rhythm. Here are the seven stages. Stage 1. Easy money creates a false boom. It always starts here. A central bank or the financial system makes money cheap and easy to get. This flood of credit fuels a frenzy of spending and investment that isn't based on real economic growth, creating the illusion of prosperity. Stage 2. Speculation pushes out investment. As the easy money flows, people stop investing in productive long-term businesses and start speculating. They buy stocks, real estate, or whatever the hot asset of the day is, not for its real value, but simply because they believe the price will keep going up. Stage 3. The smart money quietly exits. The most seasoned investors, the insiders and old money players who have seen this movie before, recognize things are getting out of hand. They see that prices are becoming unhinged from reality. Quietly, without making a scene, they start selling their assets and turning paper profits into cold, hard cash. Stage 4. The mania goes mainstream. This is the peak. The public, seeing prices only go up, piles in, driven by a powerful fear of missing out. Valuations hit absurd levels that have no connection to actual profits. The phrase, "this time is different," becomes an article of faith. Stage 5, the crack forced selling begins. Something finally breaks the spell. It could be a company failure, a change in interest rates, or a random shock. But the key is that it triggers forced selling. This is the mathematical part. When investors who have borrowed heavily see prices fall, they get margin calls. They are forced to sell to cover their loans, which pushes prices down even further, triggering more margin calls. It becomes a self-fueling cascade. Stage 6. The cascade hits the real economy. The cracks spread from financial markets to the real world. Banks that made bad loans take huge losses and slam the brakes on lending. Businesses that need credit to operate can't get it. They lay off workers. Unemployed workers can't pay their bills. The whole economy grinds to a halt. And finally, stage 7, the aftermath. The economy hits rock bottom. A generation's wealth is wiped out. Public anger leads to huge political and social shifts. The rules get rewritten, and then slowly the memory of the pain fades, setting the stage for the whole cycle to start over again. This is the pattern, a seven-stage journey from boom to bust. Now, let's see how this exact script played out in the most infamous financial disaster of the 20th century. To see the pattern in its purest form, we have to go back to the Roaring Twenties. This wasn't just a cultural revolution, it was the blueprint for every bubble that followed. Stage 1, easy credit. After World War I, America was booming, and the newly empowered Federal Reserve kept interest rates low. At the same time, a new financial tool became wildly popular: buying on installment. For the first time, average families could get cars, radios, and refrigerators for a little money down. But the most dangerous credit was in the stock market itself, the margin loan. Stage 2, speculation. With margin loans, you didn't need the full price of a stock. You could put down just 10% of the money and borrow the other 90% from your broker. This is the engine of a bubble. If you buy a $100 stock with $10 of your own money and it goes to $110, you've just doubled your money. A 10% stock gain becomes a 100% return. The temptation was irresistible. People weren't investing in Ford's future, they were betting on the ticker tape. The stock market had become a national casino. Stage 3, the smart money exits. As the frenzy grew, the men who built their fortunes on cold logic got nervous. Joseph Kennedy, a master speculator and the father of a future president, famously started selling his stocks in the summer of 1929. The popular legend says he decided to get out after a shoeshine boy gave him stock tips. He figured if everyone was in the market, there was no one left to sell to at a higher price. But the reality was based on simple math. Kennedy knew that a market built on 90% debt was fragile. A drop of just 10% would wipe out the most leveraged speculators, triggering margin calls and forced selling. He didn't need a crystal ball, he just did the arithmetic. Stage 4, prices detach from reality. On September 3rd, 1929, the market peaked. The Dow Jones closed at 381. But the real economy had already been slowing for months. Construction was down, industrial production was falling, yet the market kept soaring, completely disconnected from fundamentals. The prominent economist Irving Fisher famously declared that stock prices had reached what looks like a permanently high plateau. He, like so many others, thought the old rules no longer applied. Stage 5, the crack. The beginning of the end came on October 24th, 1929, Black Thursday. As prices dropped, the math of leverage went into reverse. That 10% drop meant a 100% loss for anyone on 10% margin. Margin calls went out across the country, but people had borrowed to their limits. The selling wasn't a choice, it was a requirement. This is the key. It wasn't just panic selling, it was forced selling. The machine that built the boom was now the engine of its destruction. On Black Tuesday, October 29th, the market completely fell apart. Stage 6, the cascade. The crash vaporized billions in wealth, but the real damage was just starting. Banks that had financed the loans were stuck with worthless collateral. As they started to go under, fear swept the nation. People rushed to pull out their savings, causing even healthy banks to collapse. Between 1930 and 1933, around 9,000 banks either failed or were forced to suspend operations. With the banking system in ruins, credit vanished. Businesses shut their doors, and unemployment surged from under 4% in 1929 to nearly 25% by 1933. Stage 7, the aftermath. By the mid-1930s, the American economy was devastated. Breadlines became a symbol of the era. This despair led to radical political change. In the US, Franklin D. Roosevelt launched the New Deal. In Europe, economic collapse in Germany helped fuel the rise of extremist politics. The crash of 1929 didn't just change fortunes, it redrew the map of the world. The 7 stages played out perfectly, and 60 years later, on the other side of the globe, the exact same sequence would repeat. Now, jump forward to the late 1980s. Japan was in the middle of one of the most spectacular financial bubbles in human history. And once again, every stage of the pattern was there. Stage 1, easy credit. In the 1980s, the Bank of Japan kept interest rates at historic lows. This unleashed a tsunami of cheap money. Corporations found it was cheaper to borrow for financial speculation than to invest in their actual business, a practice that became known as Zaytech. Stage 2, speculation. With nearly free money, Japanese companies and individuals began to speculate on a scale never seen before. They poured borrowed cash into stocks and especially real estate. The Nikkei 225 stock index tripled between 1985 and 1989. At the peak, brokerage offices had standing room only crowds cheering the ticker tape like it was a soccer match. Stage 3, the smart money exits. While the public was euphoric, some foreign investors and skeptical institutions saw the warning signs. They looked at the insane valuations and compared them to the stagnant rental income from the properties. The math didn't add up. A property's price should be related to the income it generates, but in Tokyo, that link had been broken. Quietly, these funds started selling and taking profits out of the country. Stage 4, prices detach from reality. By 1989, Japanese asset prices reached a state of mass delusion. The Nikkei hit its all-time high of 38,915. The real estate market was even crazier. It was famously said that the land under the Imperial Palace in Tokyo was worth more than all the real estate in California. While this is likely an exaggeration, it captures the absurdity of the moment. Companies were valued not on their profits, but on the perceived value of the land on their books. The world believed this time is different because of supposed Japanese superiority. Stage 5, the crack. The Bank of Japan, finally worried about the speculation, started raising interest rates in 1989. The cheap money party was over. That was the trigger. The Nikkei wobbled and then it plunged. Just like in 1929, the reversal of leverage was brutal. Companies that borrowed to speculate were hit with massive losses and forced to sell, creating the same vicious cycle. Stage 6, the cascade. In 1990 alone, the Nikkei lost an estimated $2 trillion in value. The crash soon bled into the real economy. Banks were left with trillions of yen in zombie loans, loans backed by real estate that was now practically worthless. Paralyzed by these bad debts, the banks stopped lending. The once unstoppable Japanese economy ground to a halt and entered the lost decade. Stage 7, the aftermath. The lost decade stretched into two. Japan went from being the world's next economic superpower to a cautionary tale. A generation of citizens saw their savings evaporate, leading to a culture of risk aversion that still lingers today. The pattern held. The script was proven again. Now let's look at the most recent example, the one that's still fresh in our memories. The 2008 crisis proved the pattern remains the same, even when the financial instruments get more complex. The jargon was different: subprime mortgages, CDOS, credit default swaps, but the underlying grammar of the 7 stages was identical. Stage 1, easy credit. After the dot-com bust and 9/11, the US Federal Reserve, led by Alan Greenspan, slashed interest rates to just 1% to boost the economy. This time, the ocean of cheap money flowed straight into the US housing market. Stage 2, speculation. Wall Street built a new machine to profit from this: securitization. They bought thousands of mortgages, bundled them into complex bonds called collateralized debt obligations, CDOs, and sold them to global investors. To make them seem safe, they got rating agencies to stamp them with AAA ratings. This created a ravenous demand for more mortgages to feed the machine. Lenders responded with NINJA loans: no income, no job, or assets. People weren't just buying homes to live in, they were speculating, buying multiple properties with no money down, betting they could flip them for a quick profit. Stage 3, the smart money exits. A handful of investors like Michael Burry and John Paulson looked at the actual data and saw the rot. They realized that these AAA-rated bonds were packed with toxic mortgages doomed to fail. They understood the math. As soon as home prices stopped rising, defaults would spike and the whole house of cards would collapse. So they famously made a massive bet against the housing market using a new tool called the credit default swap, CDS. Stage 4, prices detach from reality. By 2006, US home prices were completely out of sync with average incomes. The entire global financial system was leveraged on the assumption that house prices could never fall on a national scale. Financial models at the biggest banks simply didn't account for this possibility. Again, the world believed this time was different because risk had been diversified away. Stage 5, the crack. Starting in 2007, the defaults began. Homeowners with adjustable rate mortgages saw their payments soar and simply walked away. The bonds built on these mortgages imploded. The real crack came on September 15, 2008, when the investment bank Lehman Brothers declared bankruptcy. That was the moment the system broke. Stage 6, the cascade. Lehman's failure froze global credit markets. Banks, terrified of who was next, stopped lending to anyone, including each other. The plumbing of the financial system seized. The crisis spread from Wall Street to Main Street. The stock market crashed, businesses folded, and millions lost their jobs in what became the Great Recession. Stage 7, the aftermath. The world plunged into the worst downturn since the Great Depression. Governments responded with trillions in bailouts. Central banks launched unprecedented quantitative easing programs, essentially printing money to buy assets. The political fallout was immense, fueling populist movements and a deep distrust in our institutions that is still with us today. 1929, 1989, 2008, 3 different eras, 3 different assets, but the same 7-stage pattern. The same story of easy money, speculation, smart money exits, irrational pricing, a mathematical crack, a devastating cascade, and a painful aftermath. We've just walked through 3 of history's biggest financial collapses, and the pattern is undeniable. If you're starting to see the power of this 7-stage framework and you want to learn how to spot these patterns in today's markets, make sure you subscribe and hit the notification bell. We're dedicated to decoding the world of finance to give you the knowledge you need to navigate it. Don't get caught by surprise. Subscribe now. So the big question is, where are we now? As we stand here in late 2025, do current conditions match the stages of the pattern? Let's look at the evidence. Stage 1, Easy credit. For over a decade after 2008, we lived in the era of the easiest money in human history. While rates were hiked to fight the inflation of the early 2020s, the legacy of that cheap money is a world drowning in debt. As of late 2025, the IMF forecasts global public debt to be around 94.7% of GDP. In the US, total household debt has hit a record of over $18.59 trillion. Credit card balances have soared past $1.2 trillion, also a record. This mountain of debt, combined with higher interest rates, creates a fragile foundation, exactly the kind that starts the sequence. Stage 2. Speculation. The speculative mania of the last few years has been obvious. We saw it in meme stocks and the wild swings of crypto. But the biggest speculation today might be in artificial intelligence. Investor frenzy for AI has driven a massive rally, concentrating the market into a handful of tech giants. By some metrics, the top 10 companies in the S&P 500 now account for a staggering 38% to 42% of the entire index's value, a level of concentration that rivals or exceeds the dot-com peak. This is classic speculative behavior. A compelling new technology leads to a flood of money and a story that justifies any valuation. Stage 3. The smart money exits. What are the insiders, the CEOs and directors with the best view of their own companies doing? They are selling. In 2025, insider selling has heavily outpaced buying. The insider buy sell ratio, which compares the two, stood at a very low 0.29 in June 2025, far below the historical average. This indicates corporate insiders are choosing to lock in their profits. We've seen major selling from the heads of large tech firms, often near record highs. At the same time, respected investors like Ray Dalio are warning that government debt levels are becoming unsustainable, comparing the situation to an economic heart attack waiting to happen. When the people closest to the action are heading for the exits, it's a textbook stage 3 warning. Stage 4, prices detach from reality. Are valuations absurd? Let's check one of the most reliable long-term metrics, the Shiller PE ratio. It measures stock prices against average inflation-adjusted earnings from the past 10 years. The historical average is around 17. As of November 2025, the Shiller PE ratio stands at a shocking 40.95. This is more than double its long-term average. To put that in perspective, this level has only been surpassed at the absolute peak of the dot-com bubble in 1999 and briefly during the post-pandemic surge. The market today is more expensive than it was in 1929 before the Great Depression. This is by definition a market that has become unhinged from its fundamental earnings power. We are seeing clear evidence of the first 4 stages of the pattern in today's market. A world saturated with debt, rampant speculation, insiders are selling, and market valuations are at historic, eye-watering highs. This means we are now standing at the threshold of stage 5, the crack. We have traced this pattern through a century of financial history. We've seen the 7 stages of easy credit, speculation, insider exits, price mania, the crack, the cascade, and the aftermath play out in 1929, 1989, and 2008. And we've just laid out the evidence that the first 4 stages are firmly in place right now. This is not about predicting the exact date a crash will happen. Nobody can do that. Anyone who tells you they know the day is selling you something. This is about something far more powerful, pattern recognition. The goal here is to open your eyes to the script, the repeating sequence that drives these cycles. History shows that when a market is built on extreme debt and historically high valuations, a major downturn becomes a matter of when, not if. The system is mathematically fragile. At that point, any shock, a geopolitical event, a major bankruptcy, a policy surprise, can be the trigger for stage 5. The world's sharpest investors don't have a crystal ball. They have a deep understanding of history and math. They see the stages aligning and they prepare. They reduce their risk, they diversify, and they get ready for the inevitable unwind. We can't control central banks or market manias, but we can control our own knowledge and our own preparation. By understanding this 7-stage pattern, you are no longer flying blind. You can look at the evidence for yourself. You can see the flashing red lights that others are ignoring. You can recognize that when you hear talk of a permanently high plateau, the real risk isn't missing out on more gains, but getting trapped in the decline that follows. The pattern is clear, the stages are set. We know what is likely coming because we've seen it all before. The first step to surviving the storm is seeing it on the horizon.